Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey Fleck here, your host for this weekend show. Shad will be joining us in the back half of the weekend show. We're going to start off by talking more broad markets, get some insights on just how stable these markets are after what has been a wild kind of 1 month ride of a correction for these markets. And it was just about 2 weeks ago that we saw a major sell-off in the markets that turned out to be quite the buy the dip opportunity. We'll also touch on the commodities, and in the back half of the show, we'll get into the energy sector. I'm kicking off the show with Dana Lyons, fund manager and editor of the Lionshare Pro website. I'll post a link to Dana's website in the show notes. Be sure to check out that website to keep up to date with what Dana is seeing in these markets, what his models are telling him. Dana, let's just start off by recapping the last about 3 to 4 weeks of trading. I had you on the show about 3 weeks ago. That was right when the big tech names were starting to move lower. The NASDAQ was correcting, and the small caps were breaking out on higher volume. Well, everything since we chatted went almost straight down for another week or two and then immediately rebounded. Fear crept into the market. We saw the VIX spike up to levels we haven't seen in years, and then, well, the markets were bought back. And just in the last about 2 weeks of trading, something like the S&P from the low of a couple weeks ago to where we are now, it's up 8-9%. Dana, what do you take away from this volatility in the markets?
Yeah, thanks, Corey. It has been certainly an interesting month or so, to say the least. There are a couple things going on, I think. I think we can separate the broader market, which is the wide, conglomeration of stocks in general. And then you look at, the Mag 7, the mega cap tech stocks, the mega chip stocks that had led the way for a couple of years, really. I think there are two dynamics going on and a dichotomy between those two areas. So first off, from the broad market perspective, which is for us the most important thing. What's the broad market? What's the majority of the market doing? Is it going up? Is it going down? We want to align our portfolio substantially how that broad market is moving. And right now, the broad market looks fine to us. The breadth is fine. The internals look good. We're coming off new all-time highs in most of those broad averages in late July, mid to late July, including the NYSE advanced decline line, which always gives a divergence. It always tops ahead of the market. So from a broad market perspective, things look okay. Even through the recent correction, our risk model, our main quantitative model, never did give a overall sell signal on the broad market. So still looks fine to us. In fact, we think the broad averages eventually, after this kind of shakeout runs its course, we think there's going to be a breakout and a new, perhaps substantial up leg or blow off. Then you switch course back to the Mag 7, the mega cap tech names, which had led the way. I think just before the last time we spoke, we talked about some of those key Fibonacci extension levels that the averages were hitting, the S&P, NASDAQ 100, some of the semiconductor names and funds really rallied right up to those substantial levels, kissed them almost to the tick, and pulled back substantially. So they were significantly extended, significantly overowned, and we've seen, just as they led the way up for a couple of years in the recent correction, they really have led the way down, and including into the bottom, into the low about almost 2 weeks ago now. And we see those areas as still having substantial risk right here. We're looking at this correction as likely an ABC type correction where you had that initial wave down. Now we have the B wave up, and then we should have another C wave down to test or even undercut those initial lows in that high tech mega cap space. So I think right now, if you're looking to hedge yourself, if you're looking to hedge away some risk, now is like a perfect time to add some hedges in that space, which is what we're doing right now.
So Dana, when we look big picture at these markets, the S&P went through about a 10% drop from peak to trough. The Nasdaq about a 16% drop. Was that a healthy correction, or because it came so quickly, are investors right to have at least a little bit more fear in their playbook?
Yeah, I think in that area of the market, I think it was pretty much severely overowned. It probably still is severely overowned. This happened so quickly. I think there are a lot of people didn't really lighten up there, and we've gotten this bounce back. So they're probably hoping that we're out of the woods. I don't think that area of the market is out of the woods here. I think there's got to be another, like I said, that C wave down, another shakeout to kind of lighten up the excesses perhaps in that sector. So investors are not fearful in that sector right now. I think they probably should be, and they should probably lighten up, take advantage of B wave up to lighten up exposure in that large cap, in that tech, in that semiconductor part of the market, which again, I think will lead the way lower again, at least into a retest of those former lows. At the same time, there are plenty of areas that are working fine that you can rotate into, or, counterbalance any hedges you have in that tech space with some other either broad market names or defensive names that are really performing pretty darn well still.
So what are some of the best areas that you're seeing? What are some of the best names that you're seeing that still have that performance?
Okay, so and some of the same names we've been talking about for a while. On the one hand, I think a lot of broader names will eventually break out and put in new highs. Even some of the small and mid cap stuff, especially the pure value stuff that has been kind of running in place since the beginning of the year. And don't get me wrong, if we get that wave down in the mega caps, there will be some damage done in the broader market as well. But technically speaking, they're not broken. I think they hold up reasonably well and eventually break out, put in a new up leg. So into weakness, you can be buying those. Also, the defensive sectors, and this is more of a late cycle play, which tells us that next wave up, that next leg up might be it for the bull market. But you look at the defensive sectors, healthcare breaking out to new all-time highs, utilities hitting multi-year highs, consumer staples, the REITs hitting 52-week highs. So those sectors holding up well. And also a couple other sectors, industrials are holding up well. Some of the financials testing all-time highs or hitting all-time highs. Some of the insurance broker dealers that we've been in still look good. So a number of names still look fine from a technical perspective. So you can have, from a gross allocation perspective, I could see having a heavy weighting, heavy gross exposure, meaning, plenty of longs and plenty of shorts right here, even if your net exposure is pretty low throughout maybe the better part of this fall or the next month or so, the typically seasonally weak part of the year, which is another component that kind of fits in with this scenario.
Go a little bit more in depth on that, the seasonality factor, because I find this year so interesting where markets are up nicely, but we've now had two corrections right as the calendar has turned into different quarters. Q2 and then Q3 is when we saw this weakness. We all know how Q2 ended on a high note, but how might that change seasonality wise for the back half of this year?
Uh, to be honest, seasonality is kind of tracking the historical patterns. If we look at the third quarters, typically, the weakest quarter in the market, specifically July, if you're looking back, not just like major tops, but even like 3 and 6 month tops, July is the toppiest month historically in the stock market going back to the beginning. So not unusual to see the tops formed in July like we saw. And then typically the July to October period is pretty weak. We're getting a reflexive bounce here in August, which often happens. Then September is the weakest month. historically on average. And then October, like July sees the most tops, October sees the most bottoms. So it's kind of tracking historically the seasonal norms that we've seen. Of course, it doesn't have to happen that way every single year, but I would say this seasonality is pretty much tracking those seasonal patterns, historical patterns that we've come to see.
Dana, I want to ask you about this whole concept of money on the sidelines. Look, there is still a lot of cash that is in money market funds that are yielding reasonable returns. However, look, the markets have beaten these returns, but there is a bit more fear in the market. Clearly, investors are okay with holding cash on the sidelines, earning some return on that. Do you see money on the sidelines as potentially rotating into the markets if we do see some Fed rate cuts, or is that kind of a standard that we're going to see now where you can earn a little bit more with your cash, so keep it safe?
I honestly, I don't see a ton of cash, quote unquote, on the sideline. If you look at even a survey like the AAII cash allocation, it's down near historic lows where we tend to see markets top. It's back down to where we saw cash levels at the end of 2021 and some other minor tops back then, but before that, going back to the market top in 2000. So I don't see a ton of cash on the sideline. I see it cash as being quite low. And looking at bond yields, as we expect them to continue to trend higher, not in the near term, but over the long term, over the next couple decades, track higher and higher. I think you'll see deposits in money markets start to move higher and higher to track that rise in yield. So it would make sense from an investment standpoint to allocate that way as yields go up. But right now, I don't see a ton of cash on the sidelines. One of those longer term type of indicators that we look at that indicates a lot of excess in the market, too much money invested in stocks, valuations too high, that type of thing. So it doesn't preclude, like I mentioned, a one more kind of blow off top in the market, which I think will has a good chance of happening. But overall, if I'm looking at the cash situation, I would say it's pretty darn low from a historical standard.
Okay. Dana, let's move over to some of the commodities then. Gold, as we're chatting later in the day on Friday here, gold's pushing to another all-time high. On the futures market, it's over 2,500, right around 2,530. I know you like to trade GLD, and GLD, we've even seen some more impressive inflows. That whole narrative of maybe the Western investors starting to take part. That being said, we're still seeing pretty low volumes on GLD, but hey, that also is at all-time highs. You got to be liking that trade, but how much further can it go?
Yeah, for sure. We're just more or less sitting on our gold position. The miners have been a little bit more volatile like they typically are. So probably trading the miners more so, lightening up into big rallies, trying to buy the dips, that type of thing. Gold, more or less just sitting on a pretty significant allocation or decent allocation. I wouldn't be chasing any breakouts because, I mean, the way commodities tend to work. They tend to be more in a band as opposed to like stocks, which could trend more higher, more so higher, higher highs, higher lows. Commodities tend to be more constricted, so I would be hesitant to be buying breakouts, to be honest. I would more so take some profits into big up moves. So on GLD, for example, if we get up towards 240, for example, that would be the 161 fib extension from the post 2011 decline. So I'd be looking to, if we're fortunate enough to get up to 240, we'd be pulling our horns in a little bit on gold or GLD, that is.
Okay, let's talk about the miners then. Something like GDX. Look, GDX is now, it looks like making a run to those 2022 highs, but that's still off of the 2020 highs and well off of those highs from 2011. How do you like the setup in GDX on more of a short-term trading basis?
Short-term trading basis, it's okay. Like I said, it's more volatile, obviously, than the metal has been. It's hard to get There have been so many fits and starts. It's hard to get too confident. So, or like I said, we're maintaining a decent allocation in the miners, gold, silver miners, and more or less kind of trading around that on a micro basis. Right now, we got a decent allocation, looking for, next to test those highs from last month up near that 39.40 level. And then the next that target above that would be up around that 46 level, those highs from the 2020 rally. So that would be a spot that I would be looking to, pull our horns in as far as the miners are concerned. That would also be the 61 retracement from the 2011 top. So again, not necessarily banking on a breakout and a run to all-time highs in the miners necessarily. I'll take it if it happens, but we'll probably have a significantly lower allocation to it if it does happen. So, but for that 46 level, those 2020 highs, I'd be pretty happy with, to be honest.
Dana, what about the volume in something like GDX? It is almost historically low. We have to go back to almost 2013, 2012 to see this sort of lower volume. Does that play at all into where this market could go, or tell you at all about the interest in this sector?
Well, if I've been looking at it correctly, I think we saw a big volume spike in that initial rally off of those lows in the early part of the year. And we've talked about this. I think to me, that was significant in that it suggests that there's more durability perhaps to that move. Generally, you see the highest volume in down moves or right after, right at tops after long extended rally. So that's not what really we saw. We saw good volume right off the bat. So that tells us there's more to the bull market, there's more to the rally, which would be obviously a positive sign. The fact that we've seen lower volume of late is probably a constructive thing as well. You're not seeing a ton of turnover. You're not seeing a ton of distribution. It's more or less stock sitting there biding its time, refueling for another run higher. So I think net, the volume picture, not that we put a ton of stock into it, no pun intended, but I think net, it's been probably a constructive piece of the equation there.
Okay. What about silver, too? Silver is, in a way, underperformed gold. Some people look at that gold to silver ratio up around 90, which is historically a high level, thinking that silver needs to play some catch up. But what's that silver market chart looking like to you?
Yeah, and silver looks okay to us. It's often been like a higher beta play on gold. Obviously, there are other factors that play into silver than just a pure precious metals play. But for us, it's often been a higher beta play on gold. But the chart's still constructive. Looking at, we trade SLV, the ETF on silver. So that rallied, the recent high last month or so, or I guess it was a couple months ago, ran right into that 50% retracement from its 2011 high. So it did hit higher highs above those highs from 4 years ago or so. So that was constructive. As long as we maintain those higher highs on higher lows, benefit out is to the upside. I would say the next target, quote unquote target that we'd be looking at in silver and SLV, specifically up close to that 34, 35 level, which would be again a 61 retracement from that post 2011 decline. Also be a 161 extension from the pullback we saw from 2020 into those 2022 lows. So technically speaking, that would make a lot of sense. I don't know that we're going back to the all-time highs in silver. It'd be hard to bank on that. So again, with the volatility such that it is in the market, I'd be happy, maintaining a small allocation to it and then trading around it, increasing the allocation into pullbacks, and then, of course, not forgetting to take some profits into moves higher.
So Dana, before I get you out of here, then broadly, commodities, a lot have been range bound. Copper stuck right around that $4 level, although it has moved a little higher this week. Crude still very much right around, let's say, mid 70s to the $80 level. Natural gas right around $2. Any commodity sectors, whether energy, whether metals, that have your attention, I guess even more so than, let's say, gold.
The gold's a big winner right now. I think a lot of it seems to be tracking the dollar. The dollar's been pretty much in the same pattern, kind of. We had the spike, the big drawdown, then pretty much sideways for a while now. So commodities have been tracking that as well. We've had, last year, nice rallies in much of the commodity space, and then pretty much sideways. So I don't know if it's just the anti-dollar play, but I think there's a lot of that component to it, but also a lot of factor where, like I mentioned with the mega cap tech stocks, it got a little bit too popular maybe when the inflation was all the rage and people jumped on the commodity and the inflation trade. That has to get worked out. It's never easy. So the Johnny come latelys have to get burned and kind of weeded out from those positions before we can maybe make that next run at that next leg higher. So I think there's a lot of that going on. So generally, we're still bullish on commodities. Again, it's a waiting game though. So something like gold, it makes it that much more impressive that it's back up testing or hitting all-time highs. So there's a little bit more to that story than just anti-dollar pure commodity play. So that keeps us more invested in gold itself.
Okay. Dana, great chatting with you. Always enjoy hearing what you're trading, what you're seeing in the markets. Again, Dana Lyons, fund manager and editor of the Lionshare Pro website. Click that link in the show notes to follow along with what Dana is trading. Dana, thanks for your time on this weekend show. We'll chat again in another couple weeks. And everyone stick around. We're going to be right back, focusing more on the energy sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we are now shifting our focus more to the energy sectors. We're chatting with Dan Steffens, president of the Energy Prospectus Group. We will post a link in the show notes to the Energy Prospectus Group so you can keep up to date on Dan's articles, his views on the oil and natural gas prices, and even more importantly, his reports on companies, which we will be getting into. Two companies he wanted to highlight later on in this segment. Dan, starting off with a general comment on the oil price. Oil has been flat. It's actually been kind of a boring market, or at least a trendless market, as prices have more or less been stuck above the low 70s up to about the mid 80s all year, even with geopolitical issues and comments out of OPEC. We see some moves on a short-term basis, but again, not much of a trend other than sideways price action. That being said, these prices, right around $80 a barrel, are still pretty decent for oil companies. So, Dan, when you're building a portfolio or looking at companies to buy in this environment, where do you focus? Which companies do you think offer the best upside potential in a flat oil price?
Well, clearly the ones that produce a lot of oil and some that produce a lot of high value NGLs, natural gas liquids, I'm favoring those right now because I just really can't tell when is this depressed gas price going to go away and we can start getting some decent gas prices. We can talk about that in a minute. But on the oil market, there was, more and more stuff coming out about recession in China and less demand. And I think that's hurting a lot of commodities. So the oil price actually dipped briefly down to 72. And then you had this, assassination in Iran, and they blame it on Israel, which I still don't think is taking credit for it, but there's a lot of saber rattling over there. And then a few days ago, the price of WTI spiked all the way up to $80 again, and then it, pulled back a few bucks today and yesterday. And anyway, but I've spoken at several conferences since May, and in every one of them, I say the right price, in my opinion, is 75 to 85, and it seems like it's staying within that range bound, except for some brief outings in this. And I think if it goes below 75, it's not going to stay there very long. You're still getting some pretty bullish storage reports. Wednesday, EIA reported a little build in crude oil, but they reported big declines in gasoline and diesel inventory. So the demand's still there. And then I found out that the build in crude oil inventory in the U.S. was really caused by lack of exports. We had less exports of light oil because we don't have enough capacity to refine all that light oil coming out of the Permian Basin. So they're exporting that out of Corpus Christi. And we were importing a lot of heavy oil, which is what our refineries are built to handle. So anyway, I just think you have to take a long-term view, and you got to base your investment decisions on where you think oil's prices are going to settle. And then do a worst case scenario. Okay, you think, well, if it really got bad, I guess it was really had a global recession. Could it drop to 65 or 60? Well, maybe. Then run your models that way. But also, I think you need to have a base case, high case, and low case. And the really good thing from an investment standpoint, these companies have been so much more financially disciplined that their balance sheets are in really good shape. Very few of the ones that I follow have any serious current debt issues that they got to deal with. They were all cash flow. All the companies, I think one or two of them in our three model portfolios did not beat my forecast. But other than that, all of our Sweet 16 companies all beat my forecast and reported really strong operating cash flow and free cash flow, and most of them pay dividends.
Yeah, Dan, the oil companies seem to be in a more solid place than they've been in really over a decade, where the balance sheets are pristine, they're buying back shares, they're paying dividends, and 75 to 85, that range, they're doing just fine there. If there was a recessionary concern, that'd be a different story. But let's also get a quick look at how you're seeing the nat gas markets. It's finally up over 2 again, up in the 220s at the time of this recording. Do you see anything coming down the pipeline that changes the math for the nat gas markets?
Well, I mean, once you get to September, then people start thinking, hey, we are going to have another winter. But I can tell you right now in August down here in South Texas, it's been extremely hot and humid. And we've been having this onshore flow from the Gulf, so we get a lot of humidity pumping in here. And then you got 95 to 100 degrees. And I have 2 air conditioners. They run 24/7, so I'm having big electric bills. And so all of our gas-fired, we have a lot of gas-fired power plants in the state of Texas and Oklahoma, and all across the South, actually, we do. And they are running full bore. So I think it's been 13 out of the last 14 weeks, the storage builds have been way below the 5-year average. So the surplus of gas in storage, we still have a surplus. If you look at U.S. storage for gas, it's about 200 or so BCF above the 5-year average. That sounds like a lot, but we have storage capacity of 4.2 TCF of gas. We're not even close to being full in storage, but they look at that surplus, and the utilities are not worried about making it through the next winter. And so there's no bidding war. And the only time you get really big spikes in the physical gas market is when you get the utilities that bring the gas to your house or your business. They're bidding against each other for physical supply, and that's when you get these big spikes. Like I think in August of 2022, we had a spike to over $9 because the storage level was low. We were headed in. And then that's when all the LNG exporters were really ramping up with the situation between Ukraine and Russia, and Europe was worried about making it through the next winter, and there was a big demand. So it can happen. So what we're really looking for in gas is hoping for, we have a regular winter. We've had 2 warm winters in the eastern half of the United States, the 2 last years, but the long range forecast that I'm getting is this should be a colder than normal winter in the eastern United States because of La Nina in the Pacific. And then we do have 2 pretty large LNG export facilities, Plaquemines and, what's the other one? There's another big one that's supposed to come on before the end of the year. And both of those are going to be like 3.5 BCF more per day of export capacity. And a Freeport can stay online. It was offline for another month or so when that Hurricane Beryl hit, put it out of commission for a while. So it's back up now. And we get all the LNG export capacity, things run at full speed, and we do not have a surplus then because they're going to need it.
Man, we've been hearing so much about these LNG terminals and just how much that could change the market. It's, I think, almost starting to fall on deaf ears because, well, they're coming, but maybe they will cause that price spike that I know a lot of the bulls are waiting for. Back into more of the energy stocks, then you sent us a tweet that was sent out by Eric Nuttall recently that mentioned the disconnect between small and mid cap energy stocks to large cap energy stocks, especially in Canada. Now, this is a trend we are seeing in the resource sector in a lot of different commodities where the small, even mid-sized guys just are not getting any sort of capital inflows, while the majors, they seem to have cleaned up their balance sheets and are doing much better. What's some of the opportunities you are seeing within this disconnect then?
Yeah, I mean, I see so many of these companies that I follow are trading at ridiculous multiples of cash flow. I worked for Hess and we did business development. If we could buy a company for 6 times operating cash flow, and especially if they had a lot of acreage that went with it, because the only way you can get into the Permian Basin now, since all the acreage is leased up, is to buy another company. That's the only way. That's why you're seeing a lot of these deals. They're doing it to get development drilling locations as much as they are current production. And so I think that's where the opportunity is. I just finished a report on Devon and this big deal that they acquired a private company up in North Dakota that gives them like 500 more high value drilling locations and a bunch of refrac potential up there too. But those are the things that I'm looking for. In my opinion, running room is undervalued. You want to look at these companies that got hundreds and even thousands of development drilling locations that they hold the leasehold. They control that acreage. And if a lot of it is already held by production, they've already got some producing wells holding those leases, that makes that acreage even more valuable. And that's what I look for. You know, you want to make sure they got enough cash flow to survive. And that's where you run your low case and say, okay, what if oil went to 60? Are they still free cash flow positive? But a lot of these companies have so much cash flow now, and they believe that their stock is really undervalued. And that's why you see so many of these companies with stock buyback programs. They're aggressively buying back their stock, and they're paying nice dividends.
Well, in addition to them buying back their stock, could they be M&A targets where somebody else just buys their company? Because there's a big divorce between where the balance sheets are of the larger companies and the valuations, and the smaller ones. Could they use that to their advantage and scoop up some of these small to mid caps?
Yeah, and there's been several large acquisitions, and we've seen several of them that involve private companies. Like these, when we want to talk about Northern Oil and Gas, I want to talk about today, they've joined forces with SM Energy and with Vital Energy, and they've made 2 really large acquisitions that are going to impact those companies by buying private companies. And then the other one with XCL assets, I think that one might be public. But anyway, so there's a lot of money looking for deals, and the only way to get into some of these plays like the Permian Basin, especially because all the acreage is held by production, is held by other companies, and it's not leasable. So the only way you can get in there is to buy out another company.
All right, let's get into the stocks then. Northern Oil and Gas, as you said, NOG. This is an aggressive growth company. It's in your Sweet 16 growth portfolio. Also does pay a dividend of a little over 4%. This company has really been on the acquisition path with, I believe, 14 acquisitions in 3 years. Let's talk about what's going on in terms of Northern Oil and Gas, what you like about its growth profile.
Well, that's one company that has not had any trouble getting capital to make these deals because it's been pretty amazing. It's been around for a long time. They were around, I think, when I was working for Hess, and they were just kind of this little company that acquired, small working interests, and they just grown and grown and grown. And then now they've just gotten really aggressive, and it's a pretty large company. It pays a decent dividend. $1.68 is the dividend now, and I know they want to raise the dividend. I think they've raised the dividend 3 or 4 times since I've added it to our Sweet 16 3 years ago. The stock's up like 200 or 300% since I added it. But anyway, it's still 4.3% dividend yield, but it's growth. It's just tremendous production growth. They've recently SM Energy is a company that's in our Sweet 16. Actually, at the beginning of the pandemic, I was really worried about that company even making it. And man, they have just really firmed up their balance sheet. It looks really strong. So that's another one, SM Energy. for your listeners to look at. But I like this deal. What Northern did is they took 20% of an acquisition, and XM Energy took the other 80%. And XM Energy is going to operate it because Northern is a non-op company. They don't operate any of their production. So for non-op companies, you really want to look at the quality of the operating companies that they've teamed up with. And SM Energy is definitely a high-quality company. And anyway, but they're going to, Northern, I remember when they were below 10,000 barrels a day of production. Now they're going to be over 135,000 BOE per day of production. And they are heavily weighted to crude oil, like 60%, 63% crude oil. So I like it. I like the dividend, but more than that, I like the growth. And that deal with Energy where they're acquiring, they call it the XLC assets, that's a big deal. And they did a bolt-on thing too. They had an option to acquire another 20% acreage. And so they did that. So now the deal's up to about a $600 million deal just for NOG. That's just NOG's share, 20%. So multiply that by 4 times and you get what SM Energy has to pay. But anyway, looks really good. And it's going to, give them another 10,500 barrels a day of current production and a lot of development drilling inventory. So it looks really good.
Well, Dan, I wanted to dig in and maybe have you expand on them being non-operated positions. They usually have these kind of minority positions, like you're saying, another operator is doing the work, but they're kind of spreading their bets around. Like you said, it's the quality of the operators, but also is this an interesting strategy for a company like Northern Oil and Gas where they're not deploying their own people, they're not the ones actually doing the work, they're just buying the minority interest in a lot of these. How do you think that is as a business strategy?
Well, what I like about the business strategy, I used to not like because you can't control your CapEx. Because then they'll get in there, and then what if you're in with a big company like EOG, and EOG just decides to run 10 rigs out there and start drilling up everything? Then you got to keep up with those drilling costs if you want to continue to hold your interest. So your interest has to be kind of aligned with the other company. So, but now they're big enough, and they have enough. They have like $1 billion line of credit. They now have access to capital where they can easily keep up with the drilling programs. And so they don't like to take more than like 20-30% of the working interest. And then I think because they're big now, they are treated as a true partner. So I don't think SM Energy is going to try to drill them out of the deal, try to spend money so fast that they can force them out. That's not going to happen. So it's just the bigger they got, the more it made sense to do this. And so they don't have the overhead of the field people. They don't have a bunch of pumpers. They're not running rigs or anything out in the field. They're just a non-op working interest, and they just pay their invoices when they get them. I think Northern only has like 38 employees total, and it's a pretty big company to have that little of a staff. So their G&A expense is really low. And anyway, so far the numbers on it look really good. If any of your listeners want to send me a note, we just updated our profile on the company, and the forecast model looks really strong on that company.
Yeah, the key is have that money because while they don't have to operate these things, they do have those invoices coming in with the operating companies. Look, they've had so many acquisitions here. Again, 14 acquisitions in 3 years. You would assume all these are accretive, but that is their growth path, is more acquisition. So how much do they need to keep their foot on the pedal to keep this stock interesting in your eyes on the acquisition front?
Well, one thing that increased my value of it is, okay, they were in a big acquisition with Earthstone Energy, and then Earthstone was acquired by Permian Resources, a much larger company. So now Permian Resources has taken over all the operations of that stuff in the Permian Basin, which is the Delaware Basin to the western third of the Permian Basin is called the Delaware Basin. And anyway, size matters in this business. So Permian Resources is running a lot more rigs. So they get better drilling rig rates. They get better tubular rates. Their completed well costs since they did the Earthstone acquisition have gone down by 10 or 15%. So well level economics. And that's all to the benefit of Northern, their non-op partner, because then Northern gets those better drilling rates and Northern gets those better lower completed well costs. So that was a big plus for me in my evaluation. But it's the same thing with SM Energy. Their symbol is SM. Look it up. It's a big company and a very highly respected company. Their partnership with Vital Energy, Vital's a little bit smaller, but still over 100,000 BOE per day and also rapidly growing. In fact, this deal that they're making with NOG is a pretty big deal for Vital. And so all three of them, and all three of those companies are in my Sweet 16. So I know them really well. So it was really easy for me to just combine the forecast models on those companies.
Yeah, nice to see a couple of the Sweet 16 ones getting some life here and getting a little interest. Let's also bring up one that you mentioned to us that you'd like to highlight today, and that's Riley Exploration Permian. REPX is the ticker. We've actually talked to you about this company before, Dana, a couple months ago, but you're continually bullish on the growth profile, and they do have a lot of heavy weighting to crude, I think 68% crude. So how are you looking at the growth for Riley Exploration Permian?
Yeah, they're a much smaller company. They're in our small cap growth portfolio, and they've recently closed 2 acquisitions in Eddy County. That's in southeastern New Mexico. It's not too far across the Texas state line, but so their legacy field, their number 1 field, is in Yoakum County. And it is literally right on the border between Texas and New Mexico. And then if you went straight west from there, about 100 miles or so, a couple hundred miles maybe, you're in Eddy County. Now, Eddy County, some of the best wells in the United States are being drilled in Eddy County, but they're being drilled further south from where Riley is. Riley's expertise is to go into these older oil fields that were developed on vertical wells, and they're drilling horizontal wells. It's the same thing that like In-Play Oil's doing the same thing up there in Canada. So they're drilling these 1 mile long laterals or whatever, opening up a lot more of the zone and getting better well results on that. And so now about, I think 60% of their production is in Texas and 40% is in New Mexico now. So now they've got 2 core areas, and the one over in New Mexico has a lot more upside. And we talked about this in April, and remember they're in that power partnership. It's called RPC Power, where they're going out into the field and building on-site power generation, where they're using the gas like right out of the ground and they're generating electricity. And they're doing it more to increase the reliability of their electricity. I talked to them just yesterday, actually, and they're very pleased with that. They think that things got a lot of upside, and they're going to actually be generating more electricity than they're using. And every once in a while out there, because of this heat in South Texas, ERCOT, which handles our electric power source out here in Texas, they will have big peak rates where then they can sell some of that power into the grid at really high rates. And they're very enthusiastic about it. When I talk to them, they think it's a great deal. And so it just has a lot of potential. My current valuation on that stock, its symbol is REPX. I just updated my forecast model after talking to the company yesterday on a conference call. I went over my forecast model with them. I was a little bit too high on operating expenses, and I was also too high on their current income taxes. So it's raised my current valuation a couple bucks to $53 per share. And first call's price target is 47. And where is it now? It's just in the low 30s, I think. No, wait. No, only 26. It's 26.46. It closed there on August the 13th, and the current dividend is 144, so it's got a 5.4% dividend yield, and it looks to me like it could be a double for us. And my valuation is almost double the current share price.
So, Dan, this stock really hasn't done much this year. I think it is up year to date, but the last about 5 to 6 months has been choppy sideways action. It does not have nearly the uptrend that NOG, Northern Oil and Gas, does. What's the news that's going to actually get investors more interested in this stock when, I guess, in a way, it's kind of underperforming some of the outperformers?
Well, they did tell me they want to keep raising the dividend. That'll help. But I just think if they keep putting out production growth, and based on what I heard yesterday, they were very confident that they're going to report higher production in the third quarter and then higher production still in the fourth quarter. And they really have a lot of ups because they were doing a CO2 flood pilot project that had a lot of potential, but they told me yesterday that they think the potential they have in Eddy County is a lot higher. So they're going to kind of shelf that CO2 project, and they're going to go, drill more wells and develop that acreage that they recently got in Eddy County. So I mean, they're pretty bullish on their outlook, and the balance sheet's in good shape. They were able to finance those deals at pretty reasonable price, and the numbers look really good on the company. So they're in the Central Basin platform. That's the same thing with Ring Energy. Even though they're putting up really nice numbers, it's like the Wall Street gang doesn't care about the Central Basin platform. Those are shallow zones. They're not drilling these deep horizontal wells that come on at 1,500 barrels a day. But the well level economics, I mean, the wells are so much cheaper that the well level economics are really good. So you need to look at that, not just these big IP rates that come on strong and then drop quickly. But anyway.
So, Dan, just one more quick question. Then we talk a lot about U.S. stocks, and we even touched a little bit on some of the Canadian small cap stocks. But are you seeing any motivation to move more into some of the Canadian plays over the U.S. plays? Or in your eyes, do you think maybe U.S. still probably the better market for investors to go into some of those energy stocks?
Yeah, when we look at the Canadian companies, I'm just shaking my head at how cheap some of these companies are. I mean, like we've talked about Hemisphere and InPlay and Surge and Journey's one, Rock are okay. And I look at these companies, I go, they're trading for like 2 times cash flow. They're trading below the present value of just their proved reserves. And I don't know if it's a Canadian dollar or what, but I mean, yeah, the gas price in Canada is low, but Hemisphere is a 100% oil company. And I mean, it hasn't reported second quarter results yet. I get those next week, but both of those, InPlay and Hemisphere, really look good. But even the bigger ones, I mean, Baytex looks really good to me. I looked at that the other day again, and it's having some really good success in South Texas. It's based in Calgary, but it's focused more on the stuff that it's got down there in the Eagle Ford play, and they're having some really good success there. So yeah, there's some great value. I mean, all around. I mean, the only ones that are even trading like close to 6-7 times cash flow is like EOG or Devon's up there a little bit. Coterra. It's just that right now the ones that produce a lot of gas don't look very attractive to me. But a year from now, that could be all the rage, and I think it's very possible that could be all the rage on the gas side.
All right, Dan Steffens, president of the Energy Prospectus Group. Always fun to get our monthly update on the energy sector and some of the stocks you are looking at, Dan. I will also post Dan's email in the show notes. You can email him. You can also email me directly to get any of his company reports. He has offered to send those out to you. And hey, I hope you do all visit that Energy Prospectus Group if you are interested in investing in some of these energy stocks, because Dan does a great job of outlining what he likes about a number of these companies. Dan, thank you for your time on this weekend show, everyone. Thanks for tuning in to the weekend edition of the KE Report. Be sure to go back through our website, podcast, and YouTube channel. Just search the KE Report and listen to all our daily editorials and company updates from throughout the week. Everyone, thanks again for tuning in. I hope you all have a great rest of your weekend.